Thanks for joining me for a discussion on how to avoid taxes altogether. We're talking about what I consider to be the holy grail of retirement investing, the solo 401k. Let's uncover why I've given it that title, as well as what it can do for you. So as you may know, when investing in a leveraged asset like multifamily, utilizing a self-directed IRA will generate a significant tax upon capital gains events. While returns are still fantastic, how can we juice that last bit and remove taxes altogether? Well, this is where the solo 401k comes into play. To start, you are eligible to open a solo 401k when you can show self-employment income. Now, the nice thing is there's no minimum or threshold here that you need to clear. You just need to show that you've earned any self-employment income. Whether it's through a long-standing business you own or you decide to start driving for Uber, anything goes. The theory behind a solo 401k is you're now your own employer, so you can now sponsor your own plan. Once you've established the solo 401k, you can roll over current IRA, 401k, 403b, as well as many other types of assets. Unfortunately, Roth and inherited IRAs cannot be transitioned into a solo 401k and must remain in the self-directed IRA format. When choosing to invest, you'll find that with a solo 401k, you have the same rules guiding you as with a self-directed IRA. You can't actively partake in a deal, your investment can't benefit from your direct involvement, and all income must be from passive sources. Pretty standard stuff for self-directing your retirement, so nothing new to look out for here. But the huge benefit in opening a solo 401k is its exemption from UDFI taxes, known as UBIT. This occurs in a self-directed IRA when you invest in a leveraged property. But with a solo 401k, this isn't the case. You don't have to worry about taxes, and 100% of your gains are completely tax-free. And keep in mind, your solo 401k can have either pre or post-tax dollars in the form of Roth monies. Imagine growing your account through leveraged returns with zero tax incurred and being able to take distributions when you retire entirely tax-free. So why not pay taxes now when they're currently at historically low levels and then never have to have that money subjected to tax ever again, no matter what kind of investment you make? The solo 401k also allows you to contribute an even greater amount to your retirement, up to $57,000 with a $6,500 catch-up if you're over 50 years old. When you dive down further into how you end up contributing this amount, you'll find that it's enabled by earning approximately $150,000 or more from your self-employment income. And the final key benefit to a solo 401k is the ability to take out a loan of up to $50,000. This loan is not treated as a distribution, nor is it bound to any self-directed retirement rules. Once you take the loan, your funds are treated as everyday liquid cash. You could go buy a car if you wanted. Now, I wouldn't suggest that, but any purchase is available to you. The only rule for the loan is that it must be paid back within 3 years, and the interest rate is bound to within 2 points of the current prime rate, which is now sitting at 3.25%. So obviously, at 5.25%, this wouldn't be a great trick for stuffing more money into your 401k, but there are some creative ways you can go about taking the loan. You could take out a $50,000 loan, invest it in the same multifamily deal that you would have invested in had it been in your 401k, but you'll then be able to take the high paper losses generated by depreciation that multifamily offers. You'd then be able to use those losses for your current taxes and then pay your solo 401k back however you see fit over the next 3 years. So let's move into some of the drawbacks. What are the catches when it comes to a solo 401k? Well, you're not eligible to sponsor the plan if you have full-time W-2 employees. With that said, there are a few options which you'll see below. Employees of that nature are perfectly fine, and you would still be allowed to sponsor your own solo 401k. Now, it doesn't matter if you have a different company with your full-time employees and another where you're going to be sponsoring the plan. In almost all cases, you would still not be eligible for a solo 401k. And the other drawback is that the solo 401k does not provide protection from creditors, known as ERISA. This protection will only be given when you establish a multi-member plan. So let's cover that and what the solution for a solo 401k is if you do have full-time employees. The solution is the EQRP. Think of an EQRP as a solo 401k for those with full-time employees. They provide the exact same benefits, but expand your chances for eligibility. When your EQRP is established as a multi-member plan, offering coverage to your employees as well, it then provides ERISA protection from creditors. But I have to note, if you open an EQRP and do not have employees, and the plan is not a multi-member plan, your EQRP will not have ERISA protection. Because of this, and the higher costs associated with setting up an EQRP, we would not suggest a plan to anyone who does not have full-time employees. The extra costs would provide nearly no benefits. And that's it for the Solo 401k. It's a fantastic option that I hope you can make use of now or in the future. If you have any further questions or would like clarification, please feel free to reach out to me.